My theme today, on solid ground, and I'm looking at it in terms of the wider economy, households in New Zealand and businesses in New Zealand. Because I think what we need to ask ourselves in terms of, is this going to get any worse? Is this just the start of it or the end of it? Is to what extent we have a solid economy with consumers who are making money who can afford to pay their debts. So do we have a solid foundation, or is this just like a stack of cards that's ready to topple over? Now, before I go down that road, I actually want to talk a little bit about what's been happening in the US. It may not seem directly relevant to all of you, but nevertheless, there have been reports that have come up in the paper saying that New Zealand has a similar problem. And we're going to be next to go down this road. I also think that the US story has some useful lessons for us in terms of both investor behaviour, so investors' willingness to put their money into investments that they don't quite understand and where they don't quite understand the risks that they're taking on board. But also has useful lesson for us in terms of why we ended up in this situation, which is also because we had a group of borrowers who were willing to go in and buy houses that they couldn't quite afford because they didn't want to miss the boat, they didn't want to miss the opportunity of making a large capital gain, and suddenly found out that they were in deeper problems than they ever thought that they would be in. Because they thought that that's okay, if we have a problem, I will sell the house, I'll make a profit, and I'll repay the debt. And suddenly they can't even sell the properties because demand for them has dried up. So they, as much as they want to fix the situation now, they can't even do that. So we have some lessons. And I'm actually going to look at why New Zealand is actually quite different. What we're seeing in the US doesn't even need to spread around the rest of the world. It doesn't even need to become a problem outside of the small group of borrowers in the US, which is actually quite an important story, given some of the articles we've seen in the newspaper about the fact that the whole US economy is collapsing, the whole housing sector is having huge problems, and it's going to take the rest of the world with it. Well, actually, it doesn't need to. What is a subprime borrower? A subprime borrower, as Noel has said, is a borrower with a blemished credit history. These are borrowers that had problems getting money from traditional lenders. What you would expect those borrowers to do is have tougher conditions attached and have to pay more for the loan. And what actually happened was that wasn't the case. It was a bit of a disaster waiting to happen. The writing was on the wall. It was always going to end in disaster, but people ignored it at the time. The US economy was going through a period. Keep in mind what's been happening in New Zealand here while I tell the story. The US economy had been going through a really wonderful time. The economy was booming, unemployment was really, really low, interest rates were low, the housing market was booming. So people wanted to buy houses because they wanted to make a quick buck. Easy money. The people lending them the money believed that the risk attached with lending it out was low. Default rates were low, people weren't bailing on their loans, the economy was strong, why should it be a problem? So I'm happy to take on more risk and lend you even more money at a lower interest rate than I would do usually. Now in the US, it's not quite like here where you go to a bank and the banks hold those loans basically on their books. In the US, they package the loans and then sell them to investors. So the lenders were happy to lend that money out because they believed that the risk was being passed on to the investor. Not my problem, becomes their problem. The investors also didn't ask the right questions. They didn't actually ask the basic question of, am I being offered enough to compensate me for the fact that I've got a really risky set of borrowers at the other end? So we had a whole range of people who basically didn't do their homework. Now, those loans that were given to those subprime borrowers, those risky borrowers, were actually not like the traditional US loan. The traditional US borrower takes a 30-year fixed rate. Wouldn't that be nice? If interest rates go down, you break your loan, you lock back in. If they go up, you go, I don't care, I'm locked in for 30 years. Now, this group of people didn't have that kind of loan. They actually had what you call a 228 loan. So the 2 plus the 28 makes up the 30 years. The first 2 years, they offered them a really, really low teaser rate, just to get them in the door. Even worse, they based the borrower's ability to repay the loan on the very low interest rate, not the interest rate it would jump up to in 2 years' time. See why it was a disaster waiting to happen? Even worse than that, a lot of them were what we call low documentation loans. Now in the US, they've been called liar loans. They've also been called ninjas. No income, no job, no assets. No questions asked. You don't have to provide proof of income. The valuations were swept under the carpet. No one really cared. I heard the story of a woman who, on her application form, wrote down that she made $84,000 a year. She got paid by the hour at the US equivalent of Kmart. Nobody asked the questions. So yeah. The loans that we have seen default in the last 12 months are the loans that were written 2 years ago. So the initial 2-year period is now expiring. Their interest rate is jumping up. They can't afford to repay the loans. People are trying to sell their houses, but the housing market's collapsing, so they can't sell the houses either. They've gone into default. We are going to see more bad news out of the US for some time yet, because their housing boom continued into early 2006, and those 2-year rates won't expire till the beginning of next year. It's actually been part of a wider move by investors across the world in terms of believing that the economic environment was so good that the risks with investing were really low. So there's a lesson for that for New Zealanders here. We have seen people diving into property, wanting to borrow 90, 95 or even 100% without leaving that safety net if things do happen to go wrong, that just in case. We've seen people getting into finance companies without asking the right questions. What are the risks involved? If I am being offered 8.5%, 8.75%, 9%, how risky is that? I have to be taking on more risk if I'm getting more money than I'm getting in a bank. How much extra risk? Is that differential, is that extra return enough to compensate me for that risk? I'll get onto that in a minute. So what we have seen across the world in the last couple of months, investors reassess how much risk that they've taken on. And like I said, in terms of mortgages in the US, it's investors actually that were carrying the risk. We have seen an element of overreaction, an overreaction that's spread across share markets, across interest rate markets, and we're seeing here now in terms of financial organisations. Through currencies, we've seen the New Zealand dollar fall really, really sharply. It has been driven to some extent by fear. So once again, the analogy with finance companies. People don't understand what's going on, they assume the worst, and they want to get out.